Hey everybody, Smart Silver Stacker here. Hope you're doing well. Hope everybody had a great Thanksgiving. Welcome to another live stream. We've got a lot to cover in this video. I do want to start things off with this trade deal that China just signed with Saudi Arabia, which is one of the biggest de-dollarization developments that we have seen over the past several weeks or months. But this is not the only factor that leads me to believe the US dollar is headed lower much sooner. So we're going to go over several factors, but I do want to get started with China here. Do me a favor if you're in the live stream. If you can hear me loud and clear, if everything's coming through, put a 1 in the chat. That should help wake up the algorithm and lets me know everything's working. And let's just get right into this deal. So China and Saudi Arabia now have signed a bilateral currency swap agreement. Now, to get started, this is only $7 billion worth of currency that will be swapped with this agreement. It's over the next several years. Ultimately, it can be as much as 50 billion yuan or 26 billion reals. But the important thing here is that this indicates that there is going to be trade between Saudi Arabia and China increasingly denominated in their local currencies. Now, this is a big deal because Saudi Arabia, their biggest trading partner, is China. They're also the linchpin of the petrodollar system. For those of you who aren't familiar with the petrodollar, quick version, it's a system in which Saudi Arabia and all of the other Gulf countries there, all of the cartel members, if you will, of OPEC, price their oil sales in US dollars. And if we see oil from Saudi Arabia, which the Chinese import quite a bit of, it's their number one destination for Saudi oil, if that oil gets denominated in yuan or reals, whatever you want, anything other than dollars, that's a big problem for the value of the US dollar. But again, like I said, this is not the only development that we're going to get into in today's video. I took a little bit of a break for the holidays. Again, hope everybody had a happy Thanksgiving. I enjoyed the holidays, took a little downtime, kind of got out of the news cycle. And it's crazy when you come back, even after just a few days, how much can happen. And so we're going to just kind of get back up to speed in today's video. But there's a lot of things that are not looking good for the US dollar here, folks. So, of course, one of the things that I think will happen as a result of the US dollar going lower is that the price of both gold and silver will continue to rise. Now, the spot price has moved up. Gold's back over $2,000. Silver's back over $24 due to recent weakening in the US dollar. But if you check out sdbullion.com, they've still got some Black Friday sales going on, so at least you can get some relatively low premium bullion. This one in particular, they've got junk silver for $1.89 over spot. You got to buy a big bag of it to get that, but still a pretty good price for junk silver, given the recent rise in the spot price. And then also you can get a bar of gold, one of these Johnson Matthey bars, for just $9.99 over spot. So if you're thinking of doing some stacking, make sure you check them out. Now, here we go with some data from the U.S. Treasury. This is, see if I can adjust the screen here so you can see the countries there. The major holders of U.S. debt around the world. And the most recent data that we just got is from September. And one thing you'll note here is that China, for the first time in I don't know how long, maybe a decade plus, their holdings of U.S. Treasury notes have now dipped below $800 billion, down in 1 month from $805.4 billion down to $778.1. So China continues to dump these U.S. treasuries onto the market. This is part of why rates are rising. Some of the largest holders of U.S. debt around the world are selling off their U.S. treasury debt. So you got the Fed selling bonds onto the market. You got China selling bonds onto the market. This most recent month shows that Japan is selling debt onto the market as well. All of this US dollar bonds. And this is likely to continue driving rates much higher, which ultimately I believe is going to drive the Federal Reserve to come in and be the buyer of all this debt, because eventually, rates are going to go too high as all these foreign holders continue dumping U.S. Treasury. It's going to drive rates up, And eventually that will be unsustainable. We're going to talk a little bit more about that in just a few minutes and what the Fed is up to and why they are likely to have to begin printing again in the very near future, which of course will ultimately be the biggest blow to the dollar of all. But let's take a look at the US dollar index. You can see it has been declining for the past month pretty steadily, and this has coincided with the rise in gold and silver that we've witnessed. Part of the decline that we've witnessed here is also it's all about the Fed, right? The anticipation is that the Fed is closer to a pivot, and I believe that markets are getting that right, that more hikes are likely not in our future. I mean, maybe the Fed's got another hike up their sleeve, but they can't have too many more because the cracks are really starting to show in the U.S. economy. And this trend of a falling U.S. dollar, I believe, will be persistent into the future here. Let's take a look at this one. China's state banks are buying yuan. Now, if they're buying yuan, what does that mean they are selling? Well, that means they've got to be selling U.S. dollars. Yeah, the yuan has actually suffered quite a bit as the Federal Reserve has been cranking up rates. You can see on this 1-year chart, actually, let's go to the 5-year chart here of the U.S. dollar versus the yuan, and you can see that the yuan's value has been falling ever since 2022 pretty precipitously. But then if we zoom into the 1-month chart here, it's actually begun to rise. This is the Chinese currency, and this is because China is beginning to intervene in its economy by selling U.S. dollars. Now, China holds trillions of dollars in their reserves. It's not just the treasuries that they're selling now, it's actually the reserves of U.S. currency. And this is going to be a factor that continues to put pressure on the U.S. dollar as nations like China, like Japan, are forced to sell their dollars to defend their own currencies because the Fed continues to maintain rates at an unsustainably high level. And this will be another factor that puts a lot of pressure on the dollar and ultimately forces the Fed to capitulate. We got Sean Fu in the chat here, says, and once they start trading more outside of the US dollar, excess surplus will be piled into gold reserves. Got to put those cash somewhere. Yeah, exactly, Sean. Man, you're prescient because look at the next story I've got queued up here. China extends run of gold buying that's helped support prices. And thank you for the super chat there, Sean. Everybody make sure you check out Sean Fu's channel, some of the best geopolitical analysis out there, and also some really good coverage of the gold and silver markets. So if China is dumping dollars, what are they buying? Well, they're buying the yuan, but they're also buying gold. And this is one of the things that has helped to shore up bullion prices. Central banks around the world are actually on a pretty good clip. They're not quite hitting the same records that we hit in 2022 in terms of gold purchases, but they are on track for a very significant amount of gold purchasing in 2023. And I think that it's wise, I don't give financial advice on this channel, of course, but I think it's wise maybe to take a page out of the playbook of the Chinese central bank here and acquire gold. Stock up on gold. That's what I plan to do. Gold and silver, of course. I think silver perhaps has a little bit more room for appreciation. Gold may be the safer bet, but all of it is better than these fiat currencies, including the US dollar, which will continue to depreciate. Now, this is kind of an interesting story, this next one. This is about Argentina. This is this guy, Javier Milei, who has now won the Argentine presidential election. Now, I'm far from an expert on the politics of South America or Argentina or, any country for that matter. But I think this is very interesting. This guy is a libertarian. He's characterized as far right in the media. I'm not so sure that I would slap that label on him, but he says that shutting down the Argentine central bank is non-negotiable. Now, this is very interesting. Argentina has been experiencing just an absolute gutted economy. They don't have the benefit of holding the world reserve currency, and so their mismanagement of the economy has resulted in sky-high inflation, and this is a bit of a backlash, seeing this libertarian, laissez-faire capitalist Austrian school politician getting elected, which, I think is pretty cool just from my own personal standpoint, it'll be interesting to see what he is able to do in the Argentine economy. But there's a few things we can kind of take away from this story. First of all, let's just look at the price of gold and silver in the Argentine peso. So they're suffering from something like 140% year over year inflation there. And this is a 5-year chart of both. Pretty interesting to see what the price of gold and silver has done. This is a really good chart to show to those folks out there who say that gold and silver are not inflation hedges. Now, possibly the US dollar has been a good inflation hedge for the Argentines as well, but what's happened to the Argentine peso is coming for the US dollar. We just happen to have the privilege of holding the world reserve currency, so it hasn't happened here yet. But massive inflation is around the corner for the US dollar, and pretty soon I think the charts of gold and silver are going to look like this when priced in US dollars. Thank you, Shannon, for that super chat. I appreciate that. Thank you for everybody who supports the channel. And while I'm thanking all of you, I will also take the opportunity to just say, please smash that like button, subscribe to the channel if you haven't done that yet, and share these videos with your friends. Share them on social media, spread the word, because I think it's important to warn people what is coming for the US dollar. And like I said, ultimately it will be a Fed capitulation that will take the bottom out of the dollar, I believe. It'll be a return to cutting rates, to easy monetary policy, to printing. And what could drive that? Well, let's take a look at this chart. This is the Bank Term Funding Program here from the Fed. And you can see that once again, this emergency lending facility for U.S. banks has hit a new record number. As of November 22nd, this is over $114 billion. And it's not so much that this is at a rapid increase or that these banks are, going under a huge amount of pressure and having to use more and more emergency facilities, but this number just keeps slowly creeping up. And it shows you that the banks are at least under as much stress as they were back in March. And if you ask me, many of these small regional banks in the United States, because of a tightening money supply, because of a tightening of credit, because of the Fed raising interest rates, are insolvent. These banks are insolvent. As bond yields continue to rise and continue to remain elevated, the unrealized losses on low-yielding U.S. debt on the balance sheets of these banks continues to be a pressing problem. And not only that, but we are seeing increasing levels of default across the board for all types of debt, consumer debt, business debt. You have a looming commercial real estate crisis here in the U.S., and the insolvency of these banks is reflected in this emergency lending facility, which continues to take out new record highs every week. $114 billion now, and if you ask me, this is likely headed much higher. Now, what else we got? We got the U.S. consumer, who is now coming under untold pressure from rising prices and a slowing economy. The University of Michigan has now come out with their latest survey, which shows U.S. consumer sentiment dropping again on inflation fears. This one from Fox Business. And if you look at the numbers here, according to the findings of the latest University of Michigan consumer survey, consumers see inflation accelerating. I don't know if you guys can hear that ad that started playing in the background there. Sorry about that. Consumers see inflation accelerating to 4.5% over the next year, up from 4.2% in October and 3.2% in September. So consumers are also getting the hint here that the dollar is about to come under a lot of pressure. It's not going to increase in purchasing power anytime soon. In fact, inflation likely to accelerate as the Fed will be forced to cut. Another thing I want to take away from this story, I kind of forgot to mention this, but I think an important thing to take away from this story with the Argentine president, it shows you the kind of backlash that economic problems can bring. 140% inflation in Argentina, and look who gets elected. Now, nobody in the U.S. that is in the military-industrial complex, the banking interests, the folks really pulling the strings here, wants a guy like this getting elected. And while inflation can cause a backlash, another thing that can cause a backlash is a collapse of the financial sector or a slowing U.S. economy with rising unemployment. And so I think one of the things we can take away from this story it's another indication that the Fed in 2024, which is an election year after all, is going to have to do something to ease conditions for the U.S. consumer. And that is another reason why I believe the Fed is going to be returning to the printing presses very soon. And according to the University of Michigan, consumers are also getting that hint. So consumer sentiment dropping, inflation expectations rising, and this is just more economic deterioration that we are witnessing in our debt-addicted economy as the Fed continues to keep rates very high, unsustainably high for the level of debt and leverage that we have in this economy. Now, this is an interesting story from Reuters. U.S. Black Friday sales rise 2.5%. That's an interesting headline. So that sounds good, right? Except when you dig into the numbers just a little bit, just read the first paragraph of this here, you will see that this is not adjusted for inflation. So MasterCard spending poll said on Saturday that U.S. retail sales on Black Friday rose 2.5% year over year, excluding automotive sales, but that's not adjusted for inflation. So inflation, even according to the official numbers, significantly higher than 2.5%. In reality, probably double that, let's say 6 or 7% year over year. I think that's being generous. And you can see that Black Friday sales, if you adjust them for inflation, are declining year over year. And that means that the U.S. consumer is under a lot of pressure here. Just another sign of the looming slowdown, which will force the Federal Reserve in an election year to begin printing once again to ease conditions on the consumer, to bring down rates, to ease conditions for a insolvent banking sector. I don't know what ultimately will drive the Fed to print, but it is coming. And of course, the number one factor that will cause the Federal Reserve to print is the U.S. national debt, which now stands at $33.7 trillion, very close to 33.8. We're certainly going to hit 34 by the end of the year, and who knows, could be higher than that. We'll have to see how things play out. But this is the number one reason why I believe the U.S. dollar will ultimately be headed much lower, because this level of indebtedness can only ever be paid with devalued currency. Now, to finish things up here on this live stream, I want to point out that in the Middle East, one of the things that we're seeing is there is a ceasefire right now. There's an exchange of these hostages, but there is very little sign that a diminishment in this conflict is around the corner. I believe once this ceasefire finishes up, there is going to be a continued escalation in this conflict. This is the newest story. An Israeli-owned ship was targeted in suspected Iranian attack in Indian Ocean, U.S. officials tell AP. So this was from earlier today. So, a few days ago, we had a ship hijacked in, I believe it was the Red Sea, by the Houthi military there. Now we are having a drone attack on a container ship that was owned by an Israeli billionaire. So my point is here, the conflict in the Middle East, while there may be a ceasefire at the moment, signs continue to point to a regional escalation of this conflict, which ultimately it's going to cost a lot for the U.S. because we're going to certainly be sending a lot of aid over to our allies in the region. And also, this could lead to significantly higher commodity prices, significantly higher inflation in the form primarily of oil, which has been under some pressure lately. Now, the fact that oil, despite all of these continued escalations, remains under $80 a barrel, I think is indicative of just how bad the economic slowdown and the decline in demand in the U.S. is and around the world. But should this conflict escalate, should Iran get drawn in, should the U.S. and Iran go head-to-head, the price of oil, you can expect it to go much higher, which will lead to greater economic slowdown. I don't know, if printing is really going to help in that situation, but it doesn't mean they're not going to try it. So for all of these reasons, I believe the U.S. dollar is headed lower, folks, and that's why I'm getting into hard assets. That is why, even though the price of gold and silver has moved up, I think that looking back at this point from the future, our primary regret will be not having bought more. Again, not financial advice, just letting you know what I am doing. But stay tuned for more videos. I will be probably putting something out tomorrow And we got some good content lined up for you. I do want to say a big thank you to all of you for tuning in. Hope you're all doing well. Stay safe out there, folks, during this holiday weekend. Happy stacking, and I will catch you next time. Smart Silver Stacker out.